Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries that our analysts cover worldwide. Today, we'll look at how a heavy promotional campaign at AT&T impacted its quarterly earnings. Plus, we'll break down how delayed orders at U.S. retailers impacted earnings for toy maker Mattel. But first, we begin with earnings from the streaming giant Netflix. Netflix shares fell the most since April 2022 after its third quarter earnings missed analyst estimates.
This comes after Netflix had to pay about $619 million to settle a multi-year tax dispute with Brazilian authorities going back to 2022.
The results may renew concerns about the sustainability of growth going into 2026. So for more, we brought in Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
We first asked Geetha for her take on Netflix results.
Nobody saw this coming in terms of this transaction tax. It's a little bit of a catch-up charge that Netflix took in the third quarter. And there will be an ongoing charge as well, about 40 million or so per quarter. But again, nothing that will materially impact results. What that tax charge did was that it definitely depressed the margin performance. And this is something that everybody's been super focused on, operating margin numbers. Those came in definitely much lighter than what Netflix itself had projected. But actually, if you just strip out that Brazil tax impact, they would have had record operating margins. So they guided for 31.5. They would have come in at close to almost 34% if we didn't have that tax issue. I think fundamentals are definitely strong, but I think what is happening is, apart from the tax issue, was that it was just a very, very ordinary quarter. People were definitely expecting something, a much bigger beat in terms of revenue, just given that, the second half content slate has absolutely been a monster slate. I mean, we've seen some of their biggest hits ever in the third quarter. We expect to see more coming in 4Q. But none of that was really reflected in the numbers. And I think that's why you're seeing so much of nervousness.
Okay, so ordinary results at Netflix is like the new bad. Going back to the results, Geetha, what was new, I thought, in the earnings report was that they flagged the possibility of M&A, which is not something you hear from Netflix. Of course, there have been all these reports that Netflix is interested in buying assets from Warner Brothers Discovery. Do these latest results show that Netflix is now in a position where it has to make a purchase? It's a defensive buyer as opposed to an offensive buyer.
I don't know whether it has to make a purchase. They definitely left the door open, which suggests to us that they will take a long and hard look at the studio assets, not the cable networks. They made that extremely clear on the call. But the studio, if you just think about it, Scarlet, I mean, this is definitely, and I mean, we spoke about this yesterday as well. This is a once in a generational opportunity for anybody who wants to own this kind of a studio. I mean, this is a top tier studio with a lot of very, very, beloved, popular franchises across the world. We know that these titles resonate. I mean, Netflix themselves has a lot of the Warner Brother titles. They perform extremely well on the platform. So yes, it is a defensive move. But again, if Netflix doesn't, go ahead and doesn't make that purchase, I don't necessarily think that they are going to be in a much weaker position. It definitely complicates the strategy for them a little bit, just because you might have another player like a Paramount or a Comcast that becomes much stronger. But they still have a considerable lead versus all of their peers. So I don't think it's do or die.
So what's the environment like out there in terms of creating content, movies and TV shows? Is Netflix still like the first phone call you make if you're a producer or you're a writer? I've got this project, I'm going to go to Netflix and get it done. Is that because they had the biggest and maybe still have the biggest checkbook in Hollywood?
They do. They're spending close to about $17.5 to $18 billion on content every year. And, there's been a lot of concerns, Paul, in general about the rise of AI, especially now that you have Sora 2, you have all of these new tools from Google, from Meta. Is that going to be a disruptive force for all of these streaming players and Netflix? And it looks like it actually won't. We've run some numbers internally. We think that it should help Netflix actually curb content costs by about 5 to 10%. That's substantial cost savings, for all of these streaming players, especially for Netflix, which typically has used AI really, really well. You're absolutely right. They've done a great job when it comes to content. They're going to, I think, continue to do that. I mean, not only do we have the second half slate for this year, which is extremely strong. Scarlett just mentioned all of those titles, but actually looking forward to 2026, again, you have a whole host of different titles coming on the platform, including Emily in Paris. You have Bridgerton, which has been one of their biggest series, and then you have the movie Narnia, which is supposed to be like this huge event for them coming a little bit later. So they have a steady pipeline of titles that should help them, drive engagement and ultimately drive pricing.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
We move next to the luxury space. This week, the luxury goods company Kering agreed to sell its beauty division to the cosmetics and beauty company L'Oreal in a $4.7 billion deal.
The transaction includes the sale of perfume maker House of Creed, which Kering bought only 2 years ago. And this comes as Kering's new CEO, Luca De Meo, changes course in a bid to turn around the French luxury giant's fortunes. For more, guest host Lisa Mateo and I were joined by Andrea Felsted, Bloomberg Opinion Columnist. We first asked Andrea to break down what exactly the Kering transaction shows.
Well, it's being dressed up as a partnership between Kering and L'Oreal, but what it really is effectively the sale of their beauty brands to L'Oreal. They've got a new CEO, Luca De Meo. He's come in at a time when the balance sheet is very stretched. His predecessor, who is now chairman, bought a lot of things, including Creed, this very, very upmarket perfume business, a share in Valentino to try to make the group less dependent on Gucci. But that really increased debt at the same time. Gucci's really slowed down and they're having to revive it. So they're selling it for 4 billion euros in cash. That gets some money in to deal with the debt and gives the new CEO a bit more time to turn around Gucci.
Andrea, isn't this a complete turnaround? I mean, didn't the company want to bulk up the beauty and cosmetics division?
Exactly. I mean, they're saying, this is built on the potential that they created. I mean, to be fair, they bought Creed. They paid a lot for Creed, 3.5 billion euros, which I worked out to be about 14 times sales, an awful lot. But what they did, it had a supply chain. They did that as a platform to build for beauty. And the argument is they have been able to do this deal because of that platform. That's probably kind of rather generous. Luca De Meo had a big decision to make when he got in. He either had to stick with beauty and invest in it, but with that debt, it's got and the need to reinvigorate Gucci, it's got an awful lot more calls on its cash. So he just decided beauty wasn't a priority.
All right, I consider myself a Gucci expert. I read the book. I saw the movie.
You saw the movie, yeah.
Yes, exactly. So, Andrew, I mean, it's obviously an iconic brand. What are the experts saying that needs to be done? Because it's such an important part for Kering.
It is. It really is. It was at its peak in sort of 2018-19. Around that time, it was 60% group sales. Now, Kering had an amazing run with Gucci. They put in this quite unknown designer, Alessandro Michele, and the prevailing look has been very minimalist. And he came in with these big logos, clashing print, granny chic, and it was just a breath of fresh air, and it changed prevailing fashion. But that was in sort of 2016, after the pandemic, when obviously nobody was feeling terribly good, soaring inflation. It just felt very out of sync with how people were feeling, and they tried to turn it around and have a much more minimalist look, and it just wasn't Gucci. Gucci works best when it's very fashionable, when it's over the top. So they brought in Demna Gvasalia, who was at Balenciaga, and he is trying to, really revive it. He's gone back to the Tom Ford days when it was very successful. He's gone back to the Alessandro Michele days. He did this crazy film in Fashion Week that was absolutely bonkers, but it got people talking about Gucci again. I was in New York a couple of weeks ago, and I went to the store in Soho, and there was a big installation of all his things and a capsule collection. It's trying to get people interested in Gucci again, and he's sort of going back to the future to try and revive its magic. Whether it's going to work, I'm not sure. I thought he was the wrong person to be appointed, but so far he seems to be doing all the right things.
Andrea, can you tell us some of the challenges Kering has been facing? I mean, there's that slump in Chinese demand, higher U.S. tariffs as well. What are they facing?
So what we've got at the moment is the 1% are still doing very well, but they're not buying Gucci. They're buying Hermes, they're buying Brunello Cucinelli, Loro Piana. They want these very expensive upmarket things. Now, the rest of the luxury market, that aspirational customer is coming under pressure, and Gucci had a lot of those aspirational customers, particularly in the US. So you've got the sort of aesthetic going out of fashion, you've got these aspirational customers coming under pressure. It's really had a bit of a perfect storm, and it needs to really revive Gucci, and it had Bottega Veneta wasn't doing too bad, and their designer went to Chanel. So every brand is sort of got its challenges.
Our thanks to Andrea Felsted, Bloomberg Opinion Columnist. Coming up, a look at why third quarter profit at EV giant Tesla missed estimates on Wall Street.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to earnings from the EV giant Tesla. Tesla reported third quarter earnings that missed analyst expectations. This comes despite record electric vehicle sales.
It's a sign of the pressure automakers are facing from shifting federal policies and rising costs. Afterwards, CEO Elon Musk also spent the end of Tesla's earnings call pleading with investors to approve his $1 trillion pay package and blasted shareholder advisory firms that have come out against that proposal.
For more, we were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
We first asked Steve for his reaction to the recent Tesla news.
It was quite a surprise given the volume of production. You would think that the fixed cost absorption would be higher this quarter than in the past, but it didn't happen. Looks like depreciation costs increased for them. Looks like the tariff cost impact is greater than expected. And then even below the gross margin line, the R&D costs went up quite a bit. That could be viewed as a good thing because that's a sign they're pivoting to the robotaxi, the FSD, and the Optimus robots.
And Elon Musk, I guess towards the end of the call, made a plea for investors to approve his $1 trillion pay package. Quote, this is from Elon, there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane, Mr. Musk said. How did that go over on the call here? And what's the thinking among investor community about what may be a $1 trillion pay package?
Yeah, I'm not sure if money is important to him. He does have a lot already. So I do believe that it's more about the control of the company. Look, Tesla doesn't have the dual class shares like some of the tech companies have. So he does have that fear of getting pushed out, and he had that experience, right, with OpenAI. He's one of the initial investors in OpenAI, and he got pushed out. So he does have the concern. It is his baby. Look, the stocks. The other thing is the stock hasn't reacted, too negatively to the weak earnings that we saw in the last quarter. Right? There's a battle happening between the bulls and the bears, the long guys versus the near-term investors. And there are a lot of people who believes that he can achieve getting the Optimus robot up and running, getting physical AI going. So there's a lot of believers out there.
There's a lot of believers, and what the company actually reports, especially when it comes to his vehicle sales, almost doesn't matter based on this idea that Elon Musk will steer the company in the right direction. Eventually, maybe,
Exactly.
because the robo-taxis, which are in operation, but the self-driving vehicles, the humanoid robots, those are going to take a couple of years to pan out. If that, we don't have any details on it. So in the meantime,
Yeah, definitely.
what is the growth driver for this company?
Well, he definitely in the call, he doesn't talk about cars a lot anymore, other than robotaxi and FSD. He's very focused on physical AI, but at the end of the day, he needs to sell cars. He needs to continue to sell cars to actually generate the cash to support his endeavors. Now, he has launched cheaper vehicles. It would have been better if he is offering even a cheaper model, like something under 30,000 that we talked about in the past. He is expanding overseas, right? He had record sales in countries like Japan and South Korea. Now he's going into India, big market. So cars is still going to be important.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
We move next to earnings from the telecoms company AT&T.
This week, AT&T reported revenue that fell slightly short of analyst expectations in the third quarter. This was the result of a heavy promotion campaign to woo new customers in a fiercely competitive mobile phone market.
AT&T CEO John Stankey also said the carrier is up against, quote, increased marketplace activity that shows no sign of slowing through the end of the year.
For more, we were joined by John Butler, Bloomberg Intelligence Senior Telecom Analyst.
We first began by asking John to talk about AT&T's quarter that ended and just how competitive this wireless business is.
It's a very mature market right now. You've had a lot of movement and the management suite with new CEOs at Verizon and T-Mobile. So the fear is that promotional activity is going to pick up as these new CEOs try and make their mark. And I think we saw some evidence of that in 3Q. If you look at AT&T's numbers, they were truly mixed. I was really surprised at that. What we saw was revenue growth across the board, just missed estimates slightly. It was a little bit slower than everyone expected. Subscriber growth, though, was higher than expected. And that really, to me, those are the kind of financial metrics you see in a highly promotional environment, right? You're promoting heavily. There's pressure on pricing. Their average revenue per user actually fell in the quarter on the wireless front, but subscribers rose. And so you're out there trying to build up your rolls, your subscriber rolls, at the expense of revenue in the short term, on the promise that in the long term, if you can keep those subscribers, it pays back.
I always pay special attention to AT&T's results because I switched from AT&T after 15 years because of the original iPhone to T-Mobile because they had all these great deals and it seemed more fun in general. The reason I bring this up is because now AT&T is actually the smallest of the big three wireless providers behind Verizon, behind T-Mobile. Does being the underdog work for it?
It's a good question, Scarlet. What they're really doing is throwing their weight behind broadband. John Stankey, he has really pursued the broadband market in a big way. And I think a lot of it has to do with the fact that the broadband market is growing faster than wireless. It's still a mature market. It's still relatively saturated, but there's room for more growth there. AT&T is pursuing a fiber broadband strategy, and fiber is the single best way to deliver internet. Period, full stop. There's nothing better out there, and AT&T is a real leader there. So I think on the wireless front, I don't want to say they have their eye off that ball in any way whatsoever. They're going through a big modernization of the wireless network right now, standing up a lot of new spectrum. So you're going to see network quality increase significantly over time, and that will drive more net additions, I think, down the road. But if you think about AT&T, don't just think wireless. I think it's important to pay attention to what's happening in that broadband business because that really is setting the foundation for their future growth.
So, John, in the broadband business, are they competing against the cable companies? Because they've made that a key focus over the last decade or so.
Yeah, I mean, the broadband market's getting really interesting right now. What you've seen is the cable guys are losing a lot of share to fiber and particularly to fixed wireless access, which is basically a wireless link of broadband into your home. That's been a runaway hit with consumers, really popular. AT&T was late to that game, but they're getting a lot of growth in FWA right now, as it's called. So it's interesting to see the dynamic where the cable guys are losing share and the telcos are gaining share. And soon you're going to have Starlink enter the market in a bigger way. They're right on the cusp of upgrading the capacity of their constellation. And so they're going to go from a very high priced product, I think, to a much more reasonably priced broadband offering once they get more capacity up there. They're going to look to fill that. And the way to do that is to cut your prices. And so suddenly you're going to have another wireless option, which is going to be satellite. So the competitive dynamics there are getting interesting. But for AT&T and their dedication to fiber, I think they're extremely well positioned to not only hold their own, but grow from here.
Our thanks to John Butler, Bloomberg Intelligence Senior Telecom Analyst.
We move next to earnings from toy maker Mattel.
This week, Mattel reported third quarter sales and earnings that missed analyst expectations. And this comes as U.S. retailers delayed orders due to uncertainty over President Donald Trump's tariff policies.
So we tapped Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Senior Analyst, for her take.
We first asked Lindsay to comment on Mattel's delayed orders.
We heard earlier, actually in the second quarter earnings, that there were possibilities for delays. And for the toy makers, Walmart, Target, those retailers tend to take their holiday orders by July. So there was already worry sort of heading into third quarter earnings. And of course, it was a negative surprise on the top and the bottom line. Those orders were delayed further than sort of everyone expected. And they're taking smaller quantities than usual, onto their, shelves ahead of the holiday season, which was a real concern for Mattel's fourth quarter earnings, which would be coming up.
So, Lindsay, what's Mattel and some of the other companies saying about, when their products, get stamped with a tariff? Like, how much do they try to push back on the manufacturer in whatever country it comes from, say China? How much the importer may take in his or her P&L versus, how are they saying that they're navigating that?
So from the cost side, the toy makers actually have been managing this pretty well. So Mattel is forecasting less than $100 million hit on the cost side on an annual basis. They're mitigating that in several different ways. They're cutting costs in other areas. They did adjust sourcing as much as they could, selling more internationally versus the US, shifting that mix a little bit. And they did roll out some price increases in the second and the third quarter, which is ahead of holiday. So that should help protect on the profit, on the margin side for that fourth quarter. It looks like those toy makers are bearing the brunt of that cost rather than sort of passing it through towards a retailer.
Lindsay, what are the trends impacting the toy business these days? Is there, I guess a lot of electronics, but what are some of the big trends that you're paying attention to?
So a big trend that we have seen growing momentum on is really the kidult trend, which is adults 18 plus playing with more toys. And Hasbro, Mattel, Lego, they're all playing into this. So those big black box Legos that are very high price points, they've done very well the past couple of years. But Mattel is also leaning into that. A lot of their new products coming out, even with Barbie or Hot Wheels, are really collector's items. They're really aiming at that adult. And honestly, the industry was up 6% in the first half, up high single digits in the third quarter, and that's really being driven by this trend.
As we look ahead to the holiday season, I realize for companies themselves, they are already knee-deep in it. But as consumers, we're looking ahead to it. Are there any must-have items that the toy makers are really counting on, or these toy retailers are really counting on?
So I looked through all the holiday lists and I was a little bit disappointed. I didn't see any wow gifts, or what I would call a wow gift. One cool collab that Mattel has, but it's really for 2026. Pre-orders will be available in November, as they are doing a collab with Netflix, the K-pop Demon Hunters. So they are doing action figures and dolls for that series. And that should be coming out next year. And I do think that could be a big hit.
Our thanks to Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines Senior Analyst. Coming up, a look at why the hospitality company Hilton Worldwide has raised its full-year profit outlook.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to the hospitality industry.
This week, Hilton Worldwide reported third quarter earnings that beat analyst estimates. Hilton also boosted the lower end of its full-year outlook for expanding its hotel network.
For more on this, I was joined by Jody Lurie, Bloomberg Intelligence Credit Analyst. I first asked Jody what she heard from Hilton in its earnings release.
So I think, Paul, what's interesting is that Brian Egger, my equity counterpart, and I came up with the same conclusion in that they are a little bit too optimistic, it seems, in general. I think what's so funny is when you compare, and actually taking a step back, it's a little alarming when equity and credit analysts agree,
right.
just as a side note. But when you compare what their estimates were for RevPAR, looking a year ago, fourth quarter of last year, you were talking 2 to 3%, positive 2 to 3%. Now they're saying 0 to 1%. Yet for some reason, they're able to reach an EBITDA that's almost similar to what they were projecting then. So it's a little bit of a head scratcher. I guess a lot of it's coming from the cost component of it. If your revenue per available room isn't necessarily growing, but then your EBITDA is growing, you sort of say, okay, where is that coming from and what does that mean overall?
So what is the company saying about kind of just the underlying book of business? How are their bookings looking? And, what are they saying about, I guess, components of their customer base?
So if you break it out, the U.S. is a clear sort of underperformer at the moment in terms of travel. We're seeing some weakness, some more muted results on the leisure side of things. For group and business, which was supposed to be a tailwind this year, it's actually pulling back. It's a little bit decreased. Now, they're saying that group going into next year is going to be positive, but it is interesting to hear that this component where they're hanging their hat on as the area of growth is now not really performing. Now, if you look across their brands, what stood out for me, especially for the third quarter, but also year to date, is that comparing their higher end brands versus a year ago, it was very strong in terms of growth from an occupancy standpoint. But then if you look at the lower end brands, they're actually a lot weaker. So the farther down you go in terms of their quality of their brand, so if you're talking the Conrad brand, which is one of their more premier brands, Waldorf Astoria, et cetera, those have been doing pretty well compared to last year. If you go further down the line into some of their more economy scale brands, that's where it's weakest. And that speaks to that K-shaped economy that everybody is talking about.
I noted they get probably 80% of their revenue is U.S. based here. What's their international strategy these days?
So internationally, they seem to be growing a lot. They're focusing on new types of brands to get there. They definitely see certain pockets of international doing well. I mean, the Middle East and Africa actually did very well this quarter, which was an interesting component to see. And I think that they're looking at Asia, and they're sort of a little concerned to some extent, but they definitely... It was an interesting sort of dichotomy between what's going on in the U.S. and what's going on elsewhere in the world. I think where we're sort of concerned is that they are still giving back to shareholders the same level that they were, the $3.3 billion expected for this year. They have leverage that's roughly within their range of 3 to 3.5 times. But if you're talking about a 2026 that's very uncertain, you say, okay, wouldn't you want to hold onto your cash maybe just a little bit more than you're giving out?
What are the Hiltons of the world doing in terms of capacity? Is the industry, are they building new hotels? Are they taking hotels off the market? Are they building higher end or lower end? Where's the kind of the capital for this industry going?
For Hilton specifically, they're still very much growing. I mean, that was a lot of the conversation. The management team was very optimistic about growth coming from these new properties and also from new brands. I mean, they have a new lifestyle brand that they're introducing as part of their growth strategy. And I think they're trying to key into these younger consumers, getting them to go into these lifestyle brands and more of these quick service brands that might not necessarily be traditional hotels, maybe sort of tapping into what they're seeing in Airbnbs and Verbos and other sort of alternatives to your traditional hotels. Now, what I will say, though, is something that was a little bit jarring to me as a credit analyst and as somebody who likes macroeconomics is they talked about how inflation is actually reducing, and with it are rates. And I don't think that's quite the calculation I would do. But I also am sort of curious as to if the consumer is necessarily feeling that. You layer that in, they did mention a little bit about the government shutdown affecting volumes and affecting, the outlook. But I do sort of wonder what that means for other companies in the space. For example, Choice, that really depends on government in terms of infrastructure spending and long-term stays at their properties throughout the country.
Our thanks to Jody Lurie, Bloomberg Intelligence Credit Analyst.
We move next to the aerospace industry. This week, we received third quarter earnings from General Electric Aerospace and RTX.
GE Aerospace reported results that beat analyst estimates, and the company also raised its full-year outlook due to strong air travel demand.
Meantime, the aerospace and defense company RTX raised its full-year profit outlook and reported earnings that topped Wall Street estimates. This came as sales and profit rose across RTX's commercial, aerospace, and military hardware businesses.
So for more, we are joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We first asked George for his take on the results from GE Aerospace.
I think it's telling, too, that Larry Culp, the CEO of the combined companies, broke them apart and went with the aerospace business, right? That was the crown jewel. They're the largest maker of jet engines globally. I think they have probably the best technology for jet engines globally. And look, this was a really nice quarter. Margins were even stronger than we expected. I think they may be close to plateauing, though, here. There's just a heavy demand for aircraft maintenance, even higher than sort of the amount of the increase in airline traffic would indicate. Just a lot of pent-up demand, and they coming out of the pandemic. And some of the newer technology engines just aren't as robust. So a lot of people flying the old ones longer. And we heard a lot of good news about supply chain. Supply chain sounded like it was delivering for Larry. It's generally been a challenge. It was delivering, and he had parts to put on airplanes. And those were high margin parts, and he showed it in the financial statements.
Hey, George, you mentioned maintenance and repair. So does that help the company kind of offset those higher costs when you have the rise in the new engine deliveries?
Yeah, so like I said, I think we might be seeing a plateau here in the margins we're going to get out of this company. So the airframers, Boeing and Airbus, have been slow in ramping up deliveries because they're working through their supply chain challenges. So we really see Boeing and Airbus increasing deliveries of new aircraft all the way to the back end of the decade. And that increase in deliveries is will come with those new engines from GE and RTX for that matter, and those are dilutive to margins. So, so they're kind of in this sweet spot where the original equipment, shipments haven't taken off yet because Boeing and Airbus are working on that supply chain, and they're doing a lot of spare parts deliveries, and that's really juicing profitability very strongly. So next year, I think, becomes more challenging on the whole profitability front.
All right, George, RTX, the old Raytheon, that's kind of how I know this company. Tell us, what's the business of RTX? What are their specialties, and what did they report?
So they make jet engines as well, right? Competitor to GE. They make the Pratt & Whitney geared turbofan. They have the Collins business, which is all kinds of parts for aircraft. It could be brakes, it could be landing gear. And then they've got the Raytheon business, which is the old Raytheon that the defense contractor from up Boston area. And they make radars, they make missiles, they make air defense kind of equipment, and like all of those businesses in that portfolio are really clicking right now. Look, defense is going to grow slower. Yeah. It takes time. The backlog builds quickly, but it takes a lot longer to build some of those products because they're not, running down a line that are making, as many 737s or A320s where you're doing 500 or 600 a year. These are a lot slower cadence, but we're seeing a lot of demand from customers around the world for missiles and for air defense. And so that backlog continues to build, and they're building margin in that business. They're still at kind of 11-ish, 12-ish% margin that was quite good in that defense business. And then at the same time, like I just told you for GE, the strength of demand for aircraft maintenance right now and the high margin parts that go into it, thoroughly drove that Collins business. Their Collins business is a 13-ish, 14%-ish operating margin business, really seeing strong growth. Their engine business is not as strong as GE's. GE's returns in the 20+% margins. Pratt & Whitney's kind of an 8 to 9% operating margin. They've had problems with their latest narrow body engines, so they're managing some of those issues. They just don't have the volume that GE has, but they continue to see margin growth in that business too as they deliver spare parts to some of the older legacy V2500 engines, we know them as, that power old A320s. Really did a nice job in that business, and they raised guidance even more than GE going into the last quarter of the year. I think they had some of that in their back pocket, but it looked pretty nice.
Hey, George, before you go, about a minute left. They're one of the largest recipients of U.S. federal contract funding. We're talking about RTX. Can you name some of the projects they're working on with the Trump administration? What are they working on?
Yeah, so they're going to do things like Patriot missile systems. They're going to do a bunch of, Patriot air defense systems. They're going to do a bunch of missile systems like GEM-T, right? You could think of, if in air defense, they make radars as well. You use a radar, you find a target, you sort all the targets you got coming at it, and then you have to shoot a high value interceptor at that target. And the reason that interceptor is so high value is it's got to go and hit a missile approaching, your position, your country, whatever, which means you put a lot of value add in that missile so it can go find another one and destroy it. So that's part of what they're building. They'll also probably be involved in the Global Dome or whatever, our version of Iron Dome.
Nice. Golden Dome, yeah.
So there's just a lot of demand for the products that they're going to build.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney.